Let's do a full review into Alibaba Group today. Can this company really last 102 years? Hi guys, Stanley here. I'm the co-founder of valueinvestasia.com, an investment portal where we'll give you investment news and also in-depth analysis of listed company every single week. So if you are new to this channel, remember to hit that subscribe button so you will not miss out on any of our videos. Today we are continuing our stock review series where we'll try to review a stock the same way as we shop for a car or a phone. We're going to look at their fundamentals, features, risks, and how it will stack up on our value to risk chart. Alibaba Group today is a stock that we have featured before on our Premium Members Club back in 2020. So if you want to know more about our Premium Club community, you can click on the link below to find out more. Now let's get down and dirty with Alibaba Group. The market like to see Alibaba Group as the Amazon of China. Although both companies dominate the e-commerce sector in their respective market, they operate in a very different business model. For one, Alibaba Group does not sell products directly on their platform, but rather is just a software provider that links buyers and sellers from around the world. I like to see Alibaba Group as a collection of multiple virtual malls. There is a mall known as Alibaba.com where wholesalers can find products directly from manufacturers. There is another that is similar to a night market known as Taobao, where consumers can find products from small individual sellers. The name Taobao literally means fishing for treasures, and it highlights the experience for consumers when they are surfing through Taobao. Due to the huge amount of products and sellers listed on the platform, it becomes a place where consumers need to hunt for the best deals among the sea of merchandise. There is also a more upscale mall known as Tmall, where consumers can buy directly from brands. There are others such as Lazada, which serve the Southeast Asian market, AliExpress, which link international buyers to Chinese sellers. We have Fresh Hippo for fresh produce, and Ele.me for food delivery. But at the core of it, Alibaba Group can be seen as a software infrastructure company, where it provides the infrastructure to allow companies and individual sellers to do business through the internet. Then Alibaba Group will earn a fee from these sellers by providing specific services like advertising, listings, facilitating the transaction, and providing information and also systems to help the sellers manage their business. From their core commerce business, the company has branched out to other segments. Most of these new initiatives are launched as a way to improve their core commerce offering, but many have since become huge businesses in their own right. For example, Alibaba Cloud is the largest cloud computing provider in China, powering close to 40% of the public cloud infrastructure in China. With cloud adaptation in China still lagging a little bit behind the US, this is a key area of growth for Alibaba Group currently. Alibaba is also a top digital media company in China, providing media content such as news, video, movies, live streaming, and even live events. Alibaba is also a key innovator and investor in the technological startup space in China. It owns stakes in companies like Bilibili and Didi. But two of the most important investments have to be Weibo and Ant Financial. Weibo is one of the top social media platforms in China, more commonly referred to as the Twitter of China. Alibaba Group is a 30% investor in that company. It is a key advertiser on Weibo, having spent more than $188 million on promoting its e-commerce platform through Weibo, and that is about 11% of Weibo's revenue. Ant Financial is considered as an associate to the company, as Alibaba Group has a 33% economic stake in the fintech. Ant Financial owns the popular financial platform Alipay, which is the largest digital wallet in China. All financial services like loans, wealth management, fund transfer provided through the group is originated by Ant Financials. Alibaba Group is more than just an e-commerce company. It is a key infrastructure company in enabling the economic growth of China. It allows trade to happen more easily between buyer and seller. There are millions of sellers on Alibaba's platforms, providing valuable employment to the society as well. Alibaba is also a key platform for sellers on Amazon and Shopify to source for products that are manufactured in China. So with the growth in the Chinese economy and also global trade, there is a part for Alibaba to play and benefit from for this long-term trend. Moreover, it is also well positioned in key growth areas like cloud computing, digital finance, and even digital entertainment. All these segments are expected to continue growing at around 15 to 25% over the next few years. This means that the growth for Alibaba is far from over. The risk for Alibaba has become more prominent in recent months due to the aggressive crackdown by the Chinese government on monopolistic practices. Firstly, the Chinese government blocked the IPO of its main associate, Ant Financial, which was expected to reach a valuation of more than 100 billion US dollars. Then we saw the disappearance of its flamboyant chairman Jack Ma for a period after he made a comment about the Chinese banking sector. This year, Alibaba Group was also handed the largest fine in the Chinese business history of $2.8 billion for monopolistic practices. There is also talk from the authority to request Alibaba to spin off their digital media businesses as well. All this points to the biggest risk for Alibaba, which is regulational risk. But this risk is not something new, and it should be a key risk that all investors should be aware when investing in China. The major corporation in China should be able to work with the government to align their business model with the overall direction that China is heading. And a successful company in China would need to navigate that constantly. Another major risk for Alibaba Group has to be competition. In all its business segments, there are strong competition. In the e-commerce industry alone, they have to compete with established competitors like JD.com and also upstart like Pinduoduo. And not to mention other technology companies that are moving into this industry as well, like Meituan and also Tencent. After getting fined for its monopolistic practices, Alibaba now cannot restrict its seller from selling in other platforms as well. So this means that competition will only increase in the future. Yet, interestingly, despite all this negative news surrounding Alibaba Group, the company seems to be able to continue to show some growth. The most recent quarter, the company recorded a 34% growth in its revenue, but it also suffers an 8% decline in its profit. Over the past 3 years though, the company has experienced a 42% a year growth on its revenue and a 33% yearly growth in its earnings. With most of the industry where it is operating in expected to continue growing, Alibaba Group should be able to grow at least with the industry. Okay, here we come to the last segment of this stock review. Let me reintroduce to you the value to risk chart. For every company that we review here, we will plot it to our value to risk chart and rank it also on our stock review list. But of course, this is just based on my own personal experience and also my personal view, so you can agree or disagree with what I have ranked here. And I also encourage you to just maybe start your own list as we go along this series. For the value to risk chart here, this is how I'm going to read it. On the vertical axis, we have the risks. So if I feel that this company is risky, I will plot it up here on the higher spectrum of the chart. And if I feel that it is less risky, I will be plotting it way down here. As a reference point, maybe this axis, we can see it as investing in the entire market, like maybe investing in S&P 500 ETF. So way down here would be similar to just keeping our money in the fixed deposit of the bank. While all the way up high here is buying into asset like maybe Dogecoin. Very, very speculative asset should be right here. A simple way to see it is if I already own the S&P 500 ETF, will investing in this new company increase or decrease my portfolio risk? And secondly, on the horizontal axis would be my expectation on how much value that the company is offering for investors right now. All the way to the right means that I feel that this stock would massively outperform the market, while all the way to the left means that I think the stock would probably underperform the market, or maybe even show some negative return. And the center axis would be the average market return that I'm expecting. So for Alibaba, is it better to just invest in the S&P 500 ETF? Well, in terms of risk, I think Alibaba Group is still slightly riskier than the market. After all, it is mainly dependent on one key market with huge political risk. This means that for us to invest in this company, we have to really believe in two key things, which is number one, China would continue to grow economically and its people and consumer would spend more and more over time. And number two is that the government would allow Alibaba Group to succeed as well. And they believe that a successful Alibaba Group would be beneficial to China as a whole. If you don't believe in either of these two, this might not be a stock that we should even be looking at. So most likely, I'll have Alibaba up here above the market risk. So what about value? Currently, it is trading around 20 times its earning. However, much of its earning for the year is still contributed from investment gains. But still, Alibaba Group valuation can be considered as quite low based on its trading history. The sharp decline over the past few months has really made this stock cheaper and cheaper over time. I do feel that it has an attractive valuation right now, given that the fear in the market has over this stock and also most Chinese tech stock right now. So I'm expecting this stock would continue to grow with the economy of China and has a very attractive valuation now. For me, I'm going to put it right here. So, do you agree or disagree? Comment down below and let me know how you would rank this stock on our chart. Next, let's move on to our stock review ranking. In this list, I will rank each stock against one another based on how suitable I feel this stock is for long-term investors like myself. My personal favorite holding is Forever. So you can see that this ranking, as the higher it is, this stock is more suitable for investors like myself who tend to not sell a stock. And on the other spectrum would be more speculative stocks or asset down here. Since Alphabet was our first stock in the series, I have put it in the middle as a reference point. If you want to find out our full review on Alphabet Inc., remember to check out that video. Now let's compare Alibaba Group to Alphabet. Is Alibaba Group a better long-term stock than Alphabet? It is the largest technology company in China, very essential to the economic growth of China, but do I feel that it is better than Alphabet? Well, no, not really. If I have to choose between the two, I would still be more comfortable holding on to Alphabet than Alibaba. So let's add Alibaba slightly below Alphabet Inc. For full disclosure, I will also add another symbol, the hashtag, to both stocks to symbolize that these are stocks in my personal portfolio at the moment. Alright, there you have it. Let me know how you would rank this stock and what other stock do you like to see on this list. If what we go through here is slightly confusing to you, you can sign up for our free investment course at valueinvestasia.com/free course. There we'll go through with you the basics of investing and bring you up to speed on how to buy your first stock. Hope you like this segment of ours. Till we meet again, my name is Stanley. Invest safely.